Funding a retirement portfolio over 3 decades is a fight against financial gravity. Withdrawals create a continuous one-way extraction of capital, while the remaining balance is subjected to the chaotic friction of market volatility. William Sharpe, who won the Nobel Memorial Prize for his work on pricing financial assets, categorized this specific challenge of decumulation as the nastiest, hardest problem in finance. The standard response to this problem is the 4% rule, proposed by William Bengen in 1994. It advises retirees to maintain a strict 50-50 split between stocks and bonds, and withdraw a fixed 4% of their initial capital every year, adjusted for inflation. The mathematical vulnerability of this rigid approach is that it ignores the statistical reality of historical data. Rolling 30-year market periods are highly correlated. A fixed withdrawal schedule combined with a static asset allocation lacks the agility to survive severe, prolonged market downturns. To protect terminal wealth, decumulation cannot be treated as a passive spending rule. It must be formulated as a problem in optimal stochastic control, where withdrawal amounts and asset allocations are actively recalculated at every single rebalancing date. Relying on static heuristics leaves significant capital unoptimized. Extracting the maximum safe yield from a portfolio requires abandoning simple rules of thumb in favor of dynamic mathematical optimization. That optimization requires balancing two directly conflicting objectives: maximizing the reward of total expected withdrawals over a 30-year horizon, while simultaneously minimizing the tail risk of portfolio depletion, a metric known as expected shortfall. Expected shortfall isolates the tail risk by calculating the mean value of the absolute worst 5% of terminal wealth outcomes. This provides a strict mathematical boundary for measuring financial failure. This chart plots expected shortfall against expected withdrawals. The Bengen heuristic sits here, yielding low lifetime withdrawals and weak risk mitigation. But the true efficient frontier reveals an optimal curve significantly higher and further right, extracting more cash while maintaining the exact same tail risk. Reaching this optimal frontier is demanding. It requires a time-consistent dynamic program, calculating market transitions through a PIE, and defeating a persistent wraparound error. Capturing this magnitude of financial efficiency demands a numerical architecture robust enough to survive extreme boundary impulses without corrupting its own calculations. Building this architecture starts with a dynamic program. An algorithm that simply commits to a 30-year strategy at day one is inherently time inconsistent. When market conditions eventually change, the investor has a mathematical incentive to abandon the original plan. To force time consistency, the algorithm introduces a fixed risk threshold variable, denoted as W star. By locking in this specific risk parameter across all future states, the pre-commitment problem transforms into an implementable, induced time-consistent policy. At every discrete rebalancing date, the algorithm executes a dual control mechanism in two strict steps. First, it determines the optimal cash withdrawal from the total wealth pool. Only after that cash is removed does it calculate the optimal reallocation between stocks and bonds. We can see this control logic visualized on a coordinate plane, with the current allocation of stocks on the y-axis and bonds on the x-axis. This diagonal line represents a strict boundary of constant total wealth prior to any action. When the optimal cash withdrawal is extracted, the portfolio's total value drops. The state point shifts perpendicularly down to a new, lower parallel line, reflecting the exact amount of capital remaining for asset allocation. If a severe market crash or mandatory minimum withdrawal drives the total wealth below zero, the portfolio hits an insolvency boundary. The system instantly liquidates all stock holdings, projecting the state point directly onto the negative bond axis to track the accumulating debt. Isolating the withdrawal action from the allocation action prevents computational failure. It allows the algorithm to safely process strict constraints, like insolvency and maximum withdrawal limits, before it models the chaos of the open market. Between discrete rebalancing dates, the portfolio is subjected to continuous market forces. This environment is governed by a multidimensional partial integral differential equation, or PIDE. The PIDE models a dual market environment. It uses continuous geometric Brownian motion to handle standard drift and volatility, while overlaying independent jump processes to account for sudden, non-normal market crashes. Processing this continuous environment requires the numerical solver to maintain precise delta monotonicity. This property guarantees that the discrete comparison principle holds true, meaning if one strategy is strictly mathematically superior at a given time step, the algorithm preserves that ranting through the next computation. The computational paradox here is that solving the complex integral jump terms of the PIDE is highly efficient when using discrete Fourier transforms, but Fourier methods inherently possess a critical flaw when applied to optimal control problems. This diagram illustrates the hazard. The Fourier transform implicitly assumes that the data grid is periodically extended. If an impulse control, like an emergency de-risking maneuver, suddenly snaps the portfolio's stock allocation towards zero, it drives the data directly into the left boundary. Because the Fourier method treats the grid as a continuous loop, the numerical data spilling over that left edge instantly wraps around and reappears on the right side of the matrix, creating a wave of corrupted values. If this wraparound error is not neutralized, the dynamic program will ingest corrupted edge data and output mathematically hallucinated asset allocations, exactly when the portfolio is facing critical market shocks. To neutralize this, the solver deploys Algorithm 1, an asymptotic grid padding protocol. The system projects the Green's function, the mathematical core of the PIDE, onto a significantly extended auxiliary domain. Looking at our data grid, the central solution matrix is expanded outward, doubling in size both horizontally and vertically to create a massive perimeter around the true data. This newly expanded border region is populated with asymptotic constant values. These numbers are derived from sound financial reasoning, representing absolute zero-state asset allocations. The algorithm then executes a Hadamard product within this padded domain. As the discrete convolution is calculated, the periodic wraparound error is fully absorbed by these sacrificial outer layers. For the final step, the algorithm crops away the massive outer boundary, permanently deleting the corrupted data bleed and isolating a perfectly clean, uncompromised central grid. This padding technique successfully drives the wraparound error bound down past 10 to the negative 14th power. It ensures the numerical solver can process severe, zero-bound impulse controls with absolute mathematical integrity. With the mathematics stabilized, we can return to the final financial output, the efficient frontier measuring expected shortfall against expected withdrawals, evaluating different maximum equity limits. This plot maps optimized frontiers for aggressive risk profiles. These upper curves represent portfolios holding up to 130% equities via leverage. But plotting a conservative protocol, capping stocks at 50%, this new curve tracks almost exactly along the leveraged lines. At the critical threshold where expected shortfall approaches zero, the median annual withdrawals generated by the conservative 50% cap are practically indistinguishable from the absolute maximum leverage strategies. Pushing a retirement portfolio into extreme leverage does not elevate the efficient frontier. The data shows its only measurable effect is accelerating the timeline to reach maximum allowable withdrawals by a single year. This empirical finding challenges standard portfolio theory that restricting equity exposure in a 30-year decumulation phase will severely cripple the portfolio's longevity. Instead, the dynamic adjustment of the risk threshold variable acts as a structural shock absorber. It actively compensates for the 50% equity limit without sacrificing the portfolio's absolute yield. By modeling continuous market jump diffusions, expanding the domain to annihilate errors, enforcing a strictly monotonic discrete policy, the algorithm reveals an unexpected reality. Solving the hardest problem in finance does not require forcing retirees to shoulder extreme market risk. Rather, it requires pushing mathematical solvers past their computational limits to mathematically prove the efficiency of a highly conservative path.